Hello and good afternoon, everyone. This is Christina Cuprina, economist, portfolio manager at Sequoia Wealth Advisors, doing the monthly economic outlook. And I saw a lot of people registered for this one. My intention is this will all be valuable. There's a lot going on in the world. And then for those of you who are here live, I know it's the middle of the week, the middle of the day, not always the best time for people, but I want to say don't forget, send your questions in so I can make sure that your time is valuable. The time you're spending here is valuable and you're getting all your questions answered. So send in your questions, please. I already have the list of questions from everybody who's watching the recording later. Just want to make sure I catch all that. So that being said, I talk about considerations in a changing economy right now. A lot of questions came in over this last month. Some of these things that I'll talk about today have sort of come to pass, but it's a little bit of a recap on what's happened, as well as where we are today as we're heading into the second half of the year. The considerations and concerns that are still out there that we need to be mindful of, as well as the good news that's not often talked about. So for those of you who are new to this or watching this recording being sent by someone else, so maybe you don't know me necessarily, these kind of updates and outlook on the economy, the intention of this was keeping people up to date, primarily during the pandemic, was doing them every 2 weeks. Clearly now we don't need that much of Christina or that much of anything on the virtual world. So I've kind of brought them back to once a month, and it's an opportunity just to get some updates, some ideas of what's going on, some, hopefully more fun and more interesting and more enjoyable than just watching someone blather on say CNBC and whatnot. Also, it's real time for those of you that are attending. So again, questions can be answered in real time as well. Today, I'm going to cover a little bit of a recap of what happened with the debt ceiling situation, because there was a lot of questions around that in the weeks during that time. Talk a bit about the markets and the economy, which is a big number one question that I got on everyone's mind. Cover geopolitical and domestic events that are going on right now that have an economic impact or potential economic impact. And also talk a little bit about AI, because I'm still getting a lot of questions about that. But before I get started today, I want to let you know that the next webinar in July is going to be the mid-year outlook. So it's going to be the time in which we're going to have enough data to kind of likely state how the year's going to play out. Obviously, there's no guarantees or certainty. Anything can happen anytime, but usually mid-year, after earnings reports, we can get a pretty good idea how the year's likely to play out. So mid-year outlook is a really good one. That'll be next month. Then in August is going to be ARK Investments. So many of you probably know who ARK is. Kathy Wood and the team at ARK really talk a lot about innovation, about technology, about where things are happening, early stage, mid stage, and all the big sectors. We usually have one once a year. They're really interesting and fun, especially if you love innovation and technology. They'll get in probably a lot into the more of the detail on, say, the AI world and whatnot than I have the capability of talking about. Think that date is the 29th of August. So that's a tentative date right now. So again, if you want to be live on that, if you can save that time, it'd be great. So that being said, I will start off with maybe a little bit of a recap about the debt ceiling situation. So last we spoke, we were coming up on the debt ceiling debate, which was the fun little event we get in Washington where each party can argue and push to the brink the entirety of the U.S. Financial system and our standing in the world within how we run things. It's always a little concerning. It's always pretty much expected that the last minute the politicians will pull it together. However, as things have become more and more divisive and sometimes dysfunctional in Washington, there is that concern that somebody would be willing to push it over the edge. And it does take both parties to come together and come to a solution. Fortunately, it did. Largely as expected. Originally, President Biden said he would not negotiate on the subject, and he was able to hold that position of power because the Republican side of it had not come together with a consensus in their idea, and Speaker McCarthy didn't necessarily have I might not using the right political words, but the control of his party to be able to bring that consensus together. He managed to rally everybody together, came out with their proposal. That put Biden in a situation where he needed to negotiate. Was a negotiation where both sides lost, both sides won, both sides could claim victory, and we move on from that. So that is done until next year. So that being said, it's going to come up again, and we're going to continue to deal with this unless we change the rules. And highest hopes are that the cooler heads continue to prevail, and we're able to continue to run the country economically. So that was kind of that recap on last time. It didn't have a major impact, except for it took that uncertainty away, that fear and concern away that things could get really bad regardless of how the economy's doing. The other thing is the stock market has done pretty well year to date, with the exception of obviously during the series of bank failures that we had back in March. The markets are, and the question I keep getting is, we're going to a recession. Why is the stock market doing better? First off, as I mentioned in the last webinar, there's no certainty that we're going into a recession. I've said that throughout last year, and I've said it into this year, is that we already had one technical recession in the beginning of 2022. It is a possibility that we'll have another one in maybe the early part of 23, but it is by no means a certainty yet. And there's a lot of speculation on this, and there's some very well-known firms and names in the finance sector that have taken a position on this. And I want to stress, at least from my viewpoint this time, we do not have enough data to support we're going into recession. We do not have enough data to support that we will not have a recession. So I'll talk a little bit about why this is the case, because I don't want to sound like I'm just saying, hey, sorry guys, don't know. We don't know because recession has a lot of components to it. And there are some recessions that are very mild, and not even all sectors or industries or companies will even be affected by it. And that is an example of what may play out here. If unemployment stays pretty dang low, then that means consumer spending will stay pretty dang well, right? You see how that's 2/3 of our economy. Some companies will prosper in that environment, other companies will struggle. So you can have even a technical recession and not have a situation like 2008, which at this point I don't believe in any ways in the cards, barring some unforeseen shock. So a recession in itself is not really a big deal, because currently the economy is growing just over 1%. Probably be just over 1% for the quarter that's going to end next week. So that's really bad, right? We're barely growing. So the semantics behind recession, not recession, the technical recession terms, is GDP, gross domestic product, is positive or negative. So we're barely crawling over 1% right now, which is less than half what we were doing before the pandemic, and less than a third what we were doing during the pandemic. So things are actually pretty dang not good right now when you compare it to how we did. And again, the pandemic is obviously an outlier situation because there was so much excess money pumped into the system. It wasn't really a real economy. But we'll go back pre-pandemic, and we're growing in the 2s, sometimes heading up in the 3s. So based on that, we are really barely growing right now. And that's why a lot of people feel that fear and that concern. The data's coming out, the economy's slowing. The data's coming out, the economy's slowing. The data's coming out, the economy's slowing. So we may well still go into recession. But in 2021, we went from growing over 6% to negative 0.5% in early 2022. So just as an example of that, we fell from the 6th story into the basement. That was a hard, fast fall, and that was painful. And that's what you experienced in 2022. This time around, if we fall from the 1st floor to the basement, we're going to get bruised a bit maybe, but it's not going to be as bad. So recession, not recession, is a lot of times people's mind is 2008. It doesn't have to be that way. It just has to be, we have a couple of quarters of negative GDP, the economy slows down, but we're slowing from 1% to slightly below 1%. I'm not trying to make it sound like rainbows and unicorns, but also want to make you not see it as a crisis situation. During this time, companies will flourish. And there will be companies and sectors doing well, and there'll be companies and sectors that won't be doing as well. And the positioning around this will be important. That's if we get the recession. We also may not get it. Why would we not get one if, based on what I told you, right? So consumers are a little nervous, they slow down spending, economic data is slowing, we're barely growing as it is because of the government. So there has been an extraordinary amount of money pumped into various programs, and especially related to infrastructure. This money has already been approved, allocated for. I know I make this joke all the time. It's called the Inflation Reduction Act, which had nothing to do with inflation, but it did have a lot to do with infrastructure. So this amount of money that's been approved has barely been spent, and that's coming through the pipeline, right? So you got an extraordinary amount of government money focused on infrastructure, focused on building. Infrastructure is a very broad term, but the other thing about infrastructure is it's pretty dang bipartisan, which means if we get a change in 2024 into 2025 in leadership, infrastructure is something that will probably continue to be funded in one fashion or format or another. And that is ultimately a good thing for the country because we can pretty much agree that our infrastructure needs a lot of help. So it's a good thing. How to do it, what to fund, what not to fund can be a political discussion, but it is a pretty bipartisan area, which will likely continue to get that funding. So what you're seeing now in the markets is you're seeing money flow largely into tech, especially around AI, and especially in concentrated areas, and flowing into infrastructure. So that is why I talked to you last year why we have a lot of holdings in infrastructure, because that was the one area that if the economy went down, the government already approved all this money, it's going to get spent. That's why we are positioned there. And this is likely going to continue. So the stimulus, for lack of a better term, that happens from the money that's been pumped into the system can keep the economy growing in a positive direction, even if other economic data and factors are slowing down. That is why we're on that in recession, no recession, and does it really matter? As I said last time, we're still pretty much there. My favorite time of the quarter is coming up, and that is the earnings season, which will start usually about the second week of July in this case. My favorite earnings season of the year is the second quarter earnings, which again is the one that's coming up. Why do I like earnings so much? Earnings tells us if stocks are fairly valued or not. Are they undervalued? Are they overvalued? Are they valued that there's going to be an inflation or a big slowdown and they're undervalued? Or are they valued for perfection, which is not happening anytime soon? So it's a great reset when we actually get the true price of a stock. Not necessarily how they did last quarter unless they really shock us. It's how they guide us for the rest of the year. So second quarter, we tend not to get just next quarter's guidance. We tend to get guidance for the rest of the year. So it's a really important time to really get a sense of how the economy is really doing. Where is the money going? What companies are doing well? What companies are not doing well? And even more importantly, why? So I know this may sound really geeky to a lot of you. This is something I love and I spend a lot of time on. I figured if you're tuning into this webinar, you have at least a passing interest in it. So looking at that too and seeing where's the money going. It's not only where money is flowing into by the consumer spending, government spending, etc. It's also how companies are improving productivity, how they're taking advantage of situations or cutting back in other areas. So we can see, for an example, are companies cutting back on fixed expenses like office space because more and more of their teams are remote? If so, where's that office space being held? There are some areas within the country, which I'll get more into in the real estate portion, that the commercial real estate is greatly struggling. There's going to be some big problems there. And there's other areas within the country and areas within states even that are doing very well and growing. So we want to see that. Sometimes we can get a sense of that while looking at companies' earnings reports and where they have cut or plan to cut back on fixed expenses. Another one, which is interesting, is how they're using technology. So there's been a lot of spend in companies using technology for, again, optimization of productivity, optimization of structuring and whatnot. How are they using that? Where are they using it? And what is their expected continued spending? So all of these things sound like not necessarily the most exciting part of it, which was the stock going to do well or not. It tells me a lot about the overall economy. Even one company's earnings report can tell me, okay, hey, are other companies doing the same thing? Are other companies doing the same thing? Other sectors doing the same thing? How is this going to play out over the coming quarters and years? So whether we have a slowdown late this year, whether we have a recession late this year, early next year, 2025 is still looking really good. It stayed solid through all of this. And that's about as far out as we can usually see. So at this point, the idea of it is to take opportunity where opportunity shows itself, to be cautious where it's time to be cautious, and look to the best place to be, of course, depending on each individual's needs, time horizon, risk tolerance, etc. Compliance makes me say that. So that being said, I shouldn't just make a joke on that. Actually, it really is true. Everyone's situation's different, and what someone who's 20 years old and far from goal and someone who's living off that money, it doesn't matter what the economy's doing, their needs are going to be different. So that's an important thing to catch. But overall, I said, good start to the year. Not sure whether or not that start to the year will continue, but at this point, the most prudent thing to do is to be on the side that we will continue to grow. Whether it's slower growth or faster growth will be determined much more so through this earnings season. So expect a lot more information in next month's outlook for the second half of the year. Fed, a big part of what helped boost the markets too is the Fed took a pause, but they're not done yet. And they said they're not done yet, but they really might be done. They don't even know. Okay, so if the Fed raises rates from here on out, they're saying, their words, not mine, a couple more times, they think, maybe not anymore unless they really need to. They're trying to find that sweet balance point between they don't want to drive the economy into recession, they don't want to drive the markets to crash, but they want to make sure they're controlling inflation. And the inflation data is bit by bit moving down. Originally, their target is always 2%. They want inflation at 2%, 2%. We're well above that now, but we're going in the right direction. And thing to keep in mind is that the 12 years preceding, we had many, many years and many quarters and years where we had well below 2% inflation. So it's not unrealistic for it to be higher for a period of time and then still average out around the Fed's target. So the Fed's going to watch, they're going to make sure things are cooling off. They may not need to beat things to death into that, 2% target immediately. Really the biggest impact will be is at this point, the risk of them overdoing it is lessened significantly. Even if there's a couple more bumps, you still would feel that in the cost of lending. You still feel that companies will really feel it too, and the cost of borrowing. It will have an impact, but at this point, unless there's a sudden turnaround in their plans, we're near to the end of the cycle, and that's also sort of given a little bit of more lift to the markets and whatnot. Again, any questions on that? I'm trying to cover things kind of more high level. The AI space, I won't talk a ton about it. I got a lot of questions about it. I think it all started because we had speakers in our live event in December that talked about AI and ChatGPT and all that, and it caught a lot of people's attention. And then in the coming months, it sort of became more in the mainstream news. So the idea is people say, oh, you know everything about that because you talked about it last year. No. It's our job to know about trends that are happening, things that are going on in the world, here domestically at home. It's important to know that because these will have impacts on companies and the economy going forward. But it doesn't mean I or anyone on our team are AI experts on all the things that are happening in this space. And that word kind of gets thrown around a lot, kind of like the internet did in the late 90s. And so it's important to look at it kind of realistically, where the changes are happening now and where they may happen in the future. But much like the internet, when the internet came out and it started getting really popular in the late 90s and it was going to change the world and nobody would ever go to a store again and everybody just sit home on their computers and it was just an amazing technology. And then a lot of companies got really overvalued, highly overvalued, with the idea that it didn't really matter if they made money or not as long as they had eyeballs. That all crashed, the dot-com crash. And the change that happened from there on out was that the companies that emerged from that crash were the ones that figured out how to make money, how to monetize it, how to use the internet in the way that we wanted to use things, do things. So that being said, that is maybe somewhat of the same thing with AI, is that all of a sudden people start to understand it more. They kind of know what it does, don't really know what it does, know maybe pieces of what it does. But the difference between the internet and AI is the whole concept of artificial intelligence and robotics and all the technology in this area is it will affect nearly every aspect of life, nearly every industry that's out there. And many of the ways we've done things forever will change, but it won't all happen today. It's going to take time for people to learn how to use the technology. The technology is rapidly evolving, so there'll be more uses for it. Then there'll be some breaking points. Something will go bad. The government will try and regulate it, and it'll get all gummy for a while, and then it will expand into other areas. So what I'm looking at now, mostly in this space, is they're the people that produce the machinery, the equipment, the semiconductors, all of the technology around it specifically. But that's sort of open, like any company can use it to develop it. There is no one AI company. There's a lot of different companies that are participating in this space in different ways. So there's a lot of different ways to look at this. The other thing that I'm really looking at is what I call the next layer, which are companies that are utilizing AI in some form or another, and it is increasing their productivity and is decreasing their costs, right? And there's a lot of that happening. And the interesting thing is it's actually starting to happen in areas that are completely out of what you think about AI. It's happening in companies like Campbell Soup, right? It's happening with companies well outside what you call the tech space. They're finding ways to use this technology to create more efficient operations, as well as more productivity. And sometimes people say, oh, well, that's going to get rid of all these jobs. Over time, yes, a lot of jobs are going to go away, certainly. But a lot of those jobs are not jobs that people do for fun anyway. They're not. So if you can use AI to do parts of your job that are less fun, and then you can do the more creative, more interesting part of it, it can be a very different experience. So it's too soon to say. There's a lot of noise out there about it's going to change the world for the good forever. And there's also, it's going to destroy humanity. Nobody knows. Best off to take a wait and see approach. But in the meantime, pay attention how companies using it, because it's just like any other investment a company makes. If it's going to help with productivity, and if it's going to help them with their numbers, it's going to be, good for the stock price over time. That's a consideration to look. But another thing to also look at is, on a broader scale, is other changes, societal changes that this is going to take place. So sometimes it's led by a company's use or a group's use and integration of the technology. Other times it goes the other direction, where the needs of people or communities and whatnot actually drive that growth in that specific area. So it's going to take time to watch this play out. Again, wanted to talk a little bit because I had so many questions, and also really stress I'm not the one to talk to about the details on this one. I have a team of people that do this work, and some of them will be talking in the upcoming webinar. Okay, let's see. I guess I'll do geopolitical and then the real estate domestic stuff. So geopolitical obviously was a really interesting week, or maybe it was actually one day of the week, with a situation in the Ukraine, situation in Russia around the Ukraine war. I'll keep that one for last, has at least economic impacts. And talk a little bit about China right now, because China and the US, our relations are getting, it seems, worse by the week. Recently, our president called their president a dictator, and that was really, really bad. It didn't get a lot of play here, but it's kind of, our relationship is getting worse and worse and worse between the two countries. I won't get into the right or wrong of that. I'm sure there's a lot of opinions. What I'll get into is the economic considerations of it. We still depend on China, and China still depends on us. We do not have the ability to sever our relations completely without serious financial and economic impacts on both of our countries. So from an economic standpoint, that's something I'm watching closely. In the upcoming meeting between Xi and Biden, can they come together and find a way to respectfully disagree, to work together, to try to tamp down some of this rhetoric that's going on? That would actually have a meaningful economic impact if it accelerated to a certain level. Though if it happens slowly over time, prudence may be on both sides, is to start to decouple more of our dependence that we have on one another, to make any severing of ties in the future to be less impactful economically. I'm not getting into, again, the right or wrong of that. I'm getting into the reality of that, is that's a prudent thing to do as far as a national security level. That's it. The other side of it is maybe some interesting news, a little bit connected to geopolitical and commodities, is that Europe now gets the vast majority of their oil from India, which, would sound interesting. It's like India. We don't really think of India as an oil producing country. And until you read the report, so we can track global shipping. There's Vortex, and there's some other organizations that tell you who's buying what from who and who's shipping what from where. It's like global, and you can see it. So kind of investigate that further, and it turns out that India buys the oil from Russia in its crude form, and then they refine it into all the various types of oils that people want, and then they resell it. Great money for India as they mark that up, and a great option to end run around the sanctions. But ultimately, Europe's buying a whole lot of oil from Russia, and even the US, a very specialized type of distillate, I believe, from oil we're buying, but it's coming from India. It's not coming from Russia, but it's coming by way of Russia. So going further into that, you start to see how many countries that are on the sanction list are actually getting commodities from Russia indirectly through third countries, or second countries, third countries, they being the third countries. So this goes back into the fact that the conflict and the sanctions have not had a major economic impact to date, because countries have figured out how to work around them because of their national interest. And the reason I bring this up and continue to see that is, at some point, would there be a pushback to that? And if so, we would see a pretty big spike in oil prices, because when we start to track how many countries are buying this, and if all of a sudden those doors were shut, then we would have a pretty big spike in oil prices globally. So we'll see how that plays out. Right now, it looks like everyone's just kind of looking the other way, I suppose. But that is a risk at some point. For any reason, we decide that we're going to not do the whole third country lockdown, or you can't be the third country in the chain. That may change it. I give the example of oil. This is also taking place with a lot of other commodities at this time. So it's something, again, worth watching, because we do have an interesting time when we have a conflict, a pretty significant conflict with a major commodity producing country, yet we haven't had a big spike in commodities. And that is a big part of the reason. They're going through second and third countries. That could change things. In Europe, there's obviously the Kosovo, Serbia, kind of brewing little situation over there. Hopefully that can be kept contained because that would create a conflict within Europe. It's not going particularly well right now, but it hasn't also spiraled out of control. If that situation expands, what that will do is it will likely have the EU and NATO diverting more resources there, which could impact the continued support of the Ukraine and create yet another conflict in Europe. European economies are slowing. There were 2 elections recently that just concluded that may change based on the winners in those elections. That may change some of the direction of Europe and EU, not Europe, and where resources are allocated. But the European economy is meaningfully slowing, which may or may not have them want to continue to be involved in geopolitical events as much with these changes that are taking place. Again, what does that have to do with the economy? It all has to do with the economy. We're interconnected. And I keep getting all these questions on the geopolitical front. I do stress, if you want to talk about any of this in more detail, please ask me, because I want to make sure that this is also interesting and valuable to everyone. So again, there's of course a number of things going on in the world at any given time, but I do feel it's important to talk a little bit about the Russia-Ukraine situation. Not that there's really a economic impact to this, but just because of the nature of what happened over the weekend with the, well, depends how you listen to, insurrection, coup, civil war, argument between Putin and Prigozhin, whatever you want to call it. There was obviously a situation that was unplanned and could have rapidly spiraled into a very bad situation. I'm sure pretty much everyone listening to me right now already has heard about it, but Russia uses, like the US and like pretty much a lot of other countries do in conflicts, uses private military contractors, which are not officially part of their military or their armed forces. In this case, there's a mercenary group called the Wagner Group, which is a pretty, from what I understand, trained group, and also can be somewhat of a brutal group. Run by, I'll just call him Prigo because it's faster to say. And he has been Putin's buddy for a very, very long time. He got the sweetheart deal, but he's also nuttier than a fruitcake. And for a series of events, Putin decided he needed to be contained, started to say, we're taking over your army, effective July 1st. Another number of other events happened. He got mad. He decided he was going to march his people up to Moscow. His words, he's not trying to take over or kick Putin out. He just wants to make a statement. He called it a march for justice. Well, march for justice when you have what turns out now to be 8,000 troops marching towards Moscow and taking over military installations on the way is not particularly a good thing, especially in a country with nuclear weapons. So you can imagine the entire world got pretty concerned pretty quickly. Fortunately, there was a resolution to this by way of Belarusia, kind of stepped in and negotiated a truce, whereas Prigo could move to Belarusia with any of his troops that didn't want to join Russia, and they promised not to poison him, or I don't know what the deal was. But that being said, so the whole thing could have been really, really bad, and it could have rapidly accelerated what's going on over there, the instability. And it certainly could have been a situation that could have come beyond, Ukraine and Russia. And that was resolved, at least temporarily resolved. We do not really know what happened. Nobody knows. There's speculation. But when I do our Monday morning Washington Economist update, they usually have someone to talk on the most important topics. And they had some military experts. And they said, well, we think it was this, and this, but none of us know. Like, nobody knows. So one of two outcomes, either Putin is somewhat weakened by what happened, and eventually that, is his demise or his downfall, or something changes within the leadership structure in Russia. Number two is they work out their differences. Now Prigo's got his forces up in Belarusia, which is very close to Kiev. They open another front on the war. His people go from Belarusia into Kiev, and Ukraine most likely won't be able to sustain a war on 3 different sides of itself. Now, currently it's fighting on 2. So who knows how this is going to play out? Why does this matter economically? It matters economically because Europe and NATO and the US are very financially invested in this. I don't know what the current number is that we have spent there, but I think it's approaching or at or above, I don't even know, actually, I should honestly say I don't know, this 40 billion, maybe more, that we've pumped into this war through cash and through weaponry. And if this becomes something bigger, It could potentially draw other countries' resources away from taking care of their economies. Now we're involved in this war on a deeper level, and or it expands and becomes beyond the borders of Russia and the Ukraine and becomes a NATO war. So all of these things are on the table. They're not an immediate concern at this time. The quickness and how this was resolved was really important, but it is on the table and it does have some pretty big impacts. And because I got literally 3 questions about nuclear war, in my questions thing, I thought I wanted to address it. It is not today's concern. Things seem to be stable right now. But I can see a very realistic possibility in the coming months that another front is opened on the war from the north, from Belarusia. It would be within the realm of possibility. Within a second, likely, less likely, but still theoretically possible is, something happens to Putin somehow over this. But based on what I've seen today, it doesn't look like that's going to be the case anytime soon. Gosh, I've probably talked a lot about that subject. But again, 3 questions about nuclear war. I thought I better say something about this. We'll talk to anyone in more detail about this. Also, too, like I said, you're listening to me give you information. And in an environment where we have so much information coming from so many sources, you may want to see, why should I listen to you? Where are you getting your information from? I'm happy to share that. I don't have any dogs in this fight. I don't have any agenda. I'm more trying to talk about things in a way that hopefully makes more sense than a lot of what we read in the news, and also kind of ties into what's likely to happen in the world. Let's see. Let's talk a little bit domestic and then real estate, and then I'm going to pop over to the questions because there's a whole bunch of them. So domestically, there's not anything really big on the horizon immediately. The election's not till next year. And no, I'm not going to try and predict who is going to be nominated. We're way too early for that. And we'll figure that out into next year. I'm sure it's going to be a lot of fun, like our elections have been recently. But there's nothing on the economic front on the United States. The biggest issues in the United States that we should talk about economically are the bank problems are likely not over yet, especially within the regional banks. They may not lead to more bank failures, but they will lead to an impact due to the decrease in lending willingness and ability within a lot of these regional banks and larger banks as well. So a lot of companies, individuals, even if you have a mortgage, you're dependent on bank lending, right? A lot of the grease that moves our economy has to do with lending, right? And, obviously with everything that's been going on, banks have tightened up their standards significantly. In some situations, they've eliminated them. We're lending to certain businesses or groups, right? So when the money gets sucked out of the system in that fashion, you can slow down economic growth in companies, especially in companies that are heavily indebted or have a lot of need for borrowing to get through operations. That happens a lot with companies that are in the expansive stage, in the early stage, in their growth stage. They tend to borrow more money than companies that are more later stage. Though a lot of companies have borrowed money because it was so dang cheap to do so, right? Why would I spend my cash? It's cheaper to borrow. Fortunately, though, a lot of this debt doesn't come due until 2025 and beyond, so it's not an immediate concern. And we'll be watching their finances very carefully to make sure that they're able just to simply pay it off when their debt comes due. It's not going to put any burden on the company's earnings, revenues, etc. But we're not really there in a big way with most companies and most borrowing. There is some pressure on some segments of the consumer sector, which is credit card debt levels have started to rise. At this point, it is very, very, very modest, and it is primarily in the socioeconomic ladder and kind of the low middle level to low level. I'm using these terminologies as description, not as judgment, so please forgive me if those weren't the appropriate words. But more so that's something to be watching too, because it does show household pressure. A combination of inflation is a big one. It tends to impact those groups of people more than other groups of people. In addition to the fact uncertainty in the jobs market and whatnot. Even if people haven't lost jobs, they feel is less secure, so they tend not to want to spend their cash. They'd rather put it on their credit card. So a lot of factors there. It's too soon to say if that's going to become something more, but it's something that bears watching. So that's kind of the big end of the domestic end. It said inflation is starting to ease down a bit, but what hasn't eased down is government inflation. So the government oftentimes likes to pass rules and laws and whatnot that increase the cost of doing things. Again, I will not get into the right or wrong of this. I'm sure it depends on the subject and your views. However, it's reality. And why does the government do this? The government does it because they need more money. And the government can only get what Washington gives to them, or they can raise in taxes. So you're starting to see more and more where governments are trying to find ways to extract money from taxpayers, from consumers, and even from specific groups of people. So you're starting to see these interesting use taxes come up. You're starting to see these interested concepts that are to raise money, because it's more politically expedient than I'm going to raise your taxes at a state or a federal level. So there's a lot of what we'll call sneaky taxes. The problem with sneaky taxes, again, is they hit people, and there's oftentimes not a lot of control over those. So it's a factor that's not actually part of the inflation data, but it's a part of the household inflation data. I'm seeing that more and more in our planning side of it, is the impacts of those things. And I'll tell you, come this next election season, a lot of the proposals coming out there and initiatives and on the ballot and whatnot are also going to make that even bigger. It is up to the voters to decide if that's the right or wrong thing. I'm bringing it up because these can have big impacts on you, especially if you're in the stage of your life when you're living on a fixed income, because there's a lot of that coming through. Why? Some states are really pressured. Some municipalities are really pressured because what happened with the great regress of the stimulus money during the pandemic, they started spending more, and now they don't have that money coming in, and they have to figure out how to spend less, which is just really hard for governments and municipalities to do. And so you start to see, okay, we need more money for this. We got to find a way to raise it. Okay, let's go to the ballot boxes. They hit the property owners, hit this businesses or this groups of people, because they want to keep spending at the level that we're spending on. And again, I know there's a lot of different opinions on this subject. I'm bringing it up because this is a drag and a slowdown on spending and on the economy as well. So we're going to want to watch that going forward, because this is popping up more and more, and the creativity in it is pretty amazing. So you can actually do kind of an inflation calculation on any new rule that passes and the impacts it has. I don't want to sound all doom and gloom. There's actually really good ways to get around a lot of these things and understand them, so you plan and structure things appropriately. I'm bringing it up more so because I want to make sure that even if inflation's coming down, you can see costs going up. And this is going to be big. We'll see. It'll be interesting to see how the state of California does. They're working on their budget now. Because same thing, California fortunately has been wise through, I'm sorry, I can't think of his name right now, Newsom's predecessor and Newsom, to keep this rainy day fund. And that's what's saving the bacon this time around, because they about $33 billion in the hole for California for this fiscal year. It's a pretty big number, but that rainy day fund means that California is not going to have to make some major cuts yet. So that's really helpful, but still it's always that competition with who gets the money and that back and forth at a state level, and then what trickles through to different municipalities. And we'll see how that goes. So the solution for the states and municipalities is, how do we raise more money without raising taxes? And that's the balance that we're going to see. And this is something very important to watch. Why, again, this impacts everyone, right? Every single person is going to get impacted, whether it's in what, regardless of where the taxes end up or the fees, the costs end up. Really want to keep an eye on that one going forward from the domestic aspect of it. On the other side of the domestic aspect of it is the stimulus around infrastructure that's being handed out. It's sort of odd how it's being handed out. So it's kind of, the infrastructure is going in a lot of different ways for a lot of different purposes. Some of it is specifically set aside for green energy, getting us off our dependence on fossil fuels. Very targeted. The other one is your kind of roads and bridges and your traditional things. Again, a lot of competition there, largely competition between obviously states, municipalities, who needs it the most, who's going to do the greatest good, who's got the best Washington connections, however all these things play out, and how that money goes through a sense of urgency and things like that. So it's a little too soon to say what the impact is, and it's sort of a weird thing because you don't see the impact right away. You'll see the impact on the companies that get the contracts, and they're going to benefit from doing the work. But you don't necessarily see the other thing, which is if the roads are in better shape, if we have better ways to transport goods, if the grid works and the power doesn't go out every month, that actually has an economic impact too to the regions that are doing this. And you continue to see that even within states, some states have better infrastructure than other states. And even within states, some have really good infrastructure here and poor infrastructure here. So that building up can make states even more or less attractive as companies move around and decide where they want to be. Also could be good economically good for people and whatnot. So this is, I want to make sure I'm not coming across as like government spending is bad. This is not. It's like anything else. There's two sides to it, but this is stimulative to our economy. And I just want to make sure I'm bringing that up and touching upon that. Biggest issue. Okay. Real estate, last one. And then I'll cover the questions. Real estate continues to defy everyone's expectations. And that's one where I could say I've been kind of shouting this from the rooftops for a while. It's not about interest rates. It's not about the economy. It's about the housing. Now, interest rates have an impact on mortgages. The economy has an impact, certainly. But we have 40 million homes below what's necessary at this point. And that's one number. That's the national number. You can pick numbers out a whole lot of different ways. We simply do not have enough housing, not only for our population, but even for our population that is, I want to buy a house. I have the money. I'm ready to do it. We don't have, and we especially don't have a lot of housing in the lower price points. Okay, this is a national problem. And what happens is that the cost of building is so great that it's almost impossible to build a house unless it's subsidized by the government to build a house at an affordable rate for increasingly number of parts of the country. Excuse me for a moment. The reason for this, cost of labor, cost of materials, cost of government regulations, permits, requirements, combination of a lot of factors, but it's very, very expensive to build a house. And you can see an example of that when State Farm has pulled out of California, will no longer issue new homeowners policies in California, insurance policies. Why? It's too expensive for them to rebuild. It's just the numbers, they have to be very, very careful that they can always meet all their obligations. And it was just getting to a point where that was at risk. Excuse me. So they pull out of California. This is not a reflection on California necessarily. It's a reflection on cost. It's just the cost of building is very high. So if you look at that for replacing a house, burned down in a fire or a flood, etc., what does it cost to build a house? If you want to build a house at a lower price point, it's really expensive. Some things can be done at a state level. You can get rid of the cost of permits. If you build a house at a certain price point, we're going to waive all these costs and fees, and that would make the house more affordable to build. But the cities and states need that money. They're dependent on it. Their schools are dependent on it. Their roads are dependent on it. Their parks are dependent on it. So it's really hard for them to say, oh yeah, you know what? You're building affordable housing. We're not going to charge you these fees. So it's challenging. You have to pay the workers a fair wage. If they're union, pay them sometimes even a higher wage. Materials have a cost, right? So there's not a lot that can be done without subsidization of this housing, which is a massive cost and massive undertaking. But this is the challenges that's happening about big swaths of the United States. We don't have enough housing. So for those that can afford housing and can locate housing, we're continuing to see rise in prices. Again, every market is different. There's some exceptions, some very notable exceptions of where that's not the case. I would expect that housing will not continue to rise at the rates that we've seen pre-pandemic or during the pandemic. That's unlikely to happen anytime soon. But nor is it likely to be a major crash, barring a significant situation that's not foreseeable now. And it's not going to be high interest rates for sure. It may not even be a recession. Around 40% of the house transactions are taking place are cash. So lending, the cost of borrowing is not as much of an issue. A whole nother webinar could talk about some ideas around that and some solutions around that. But at this point, we're not seeing that, especially on the markets, the desirable markets people want to live in. I will talk though about the other side of real estate. Well, there's lots of sides, but let's talk about commercial real estate because that's a little bit of a different animal right now, especially large projects in major cities that have declining populations. Okay, that is a big, big, big deal. So we all probably know at this point about what's happening to a lot of office buildings and office spaces, especially in cities where people have largely remained remote or remained hybrid and not coming back to the office all the time. So I'll pick on San Francisco for a minute here. And I'm not picking on San Francisco because I don't like San Francisco. I'm using them as an example because I'm more familiar with them than say New York and other markets that are experiencing the same thing. During the pandemic, pre-pandemic, San Francisco was booming. It was the hot spot for tech companies. A lot of tech companies moving in there, a lot of people moving there residentially. We heard the word gentrification all the time. It was just like this big shift and it was incredibly expensive to live there, but it was very in high demand. Then the pandemic hit. Some people realized that 600 square foot apartment isn't cutting it when you can't leave. And oh, by the way, I can work anywhere I want. So people decamped for other states, not even within state, either outside into suburbia, more rural, or even out to other states. And the post-pandemic, their population's not coming back. There's a lot of factors in that, not ones I really think I need to get into the purpose of today's webinar. There's a lot of things that are driving that, but the thing is, people are not coming back to live. They're not coming back to work in a meaningful way yet. And that is a death spiral for a city because the revenues don't come in from taxes. If leases aren't renewed, the revenues don't come in from the taxes. If conferences aren't happening there and the convention centers are drying up, hotels start to shut their doors, retail operations move out because of concerns about security, and all the other issues going on, and or the customers aren't there, the workers aren't shopping on their lunch break. So this spiral can be reversed. It was reversed. New York went through a terrible time in the late 70s, I think early 80s, and they were able to reverse that. And it was like the place to be pre-pandemic. Again, it reemerged. So it can be done. It's going to take a lot of decisions that the leadership is going to have to make, and to really kind of bring that around as possible. But why I bring that up right now, why again does this matter economically? Because it is kind of cities like that in that situation are experiencing a lot of pressure on their commercial real estate. And again, San Francisco is not alone here. I am not picking on them. It's an example. Commercial real estate tends to be a heavily leveraged vehicle. It tends to be heavily leveraged. The idea of an office building is you got so many tenants in there, even if a bunch move out, you got a bunch more, and it's usually well managed. But nobody in any of their pro formas or any of their predictions or any of their analysis ever factored in that people didn't come back to the office, that we would be locked down and the leases weren't being renewed, or people were downsizing their leases, moving to different locations. So with these heavily leveraged office spaces and these heavily leveraged hotels and other types of commercial real estate, people are starting to walk away from them. So shades of 2008, they're literally starting to walk away. They're like, we're not going to make this up ever. We might as well just walk away. And that's happening in some of these cities. And so the challenge in the commercial real estate, and again, I'm specifically talking about certain communities, certain types of real estate. It's not all commercial real estate by any means, but some of those heavily leveraged items are going to be in trouble. And some of these pension funds that hold them, whatnot, could see some impacts with that. But it also, again, like it impacts everything. It impacts the local businesses around there. And it's going to take a little while to see a recovery in that space, and we could see some significant defaults before it's over. Again, high level, not all is created equal. There are plenty of really well-run commercial real estate funds. There's a lot of really well commercial real estate properties, but there's also a lot that, through no fault of their own or some fault of their own, are going to be in a lot of trouble. Like I said, so I just want to really talk about that in a space. And like, the one thing about news is always like, it's all fine or it's all terrible. There's often not the middle ground, and it is a bit of a middle ground. It's like I said, how things are run. So I want to make sure I cover that, because there's just a lot of questions on those spaces. And I just feel like I talk a lot. So you guys, I'm going to go to the questions now, the things you actually want to know about. And again, always give me your input, your feedback, and whatnot. This is sort of one of the monthly webinars where people say they really want me to do them, but I don't have a ton of new stuff. Just kind of touching on what's happened last time. Whereas the next two webinars will be full of a lot of stuff, and also not just me. All right, questions coming up. Is there significant risk to the economy due to the rapidly escalating commercial real estate vacancy rates? Yes. Just maybe I answered your question already with that. But I want to touch upon the fact that vacancy affects more than just the owners of the building. It affects the entirety of the community. So, when you go to an office building and it's mostly vacant, it doesn't mean that the rent's not being paid. Maybe, why would you not pay your rent? Why would you default on your rent? At a company, you just keep paying the rent. You just let your workers work remotely because that's what works now. You pay your rent until your lease is up. But in the meantime, even though your space is leased, your employees are working from everywhere else. So they're not going to the local restaurants. They're not going to the bars afterwards or the breweries afterwards. They're not doing as much of the social activity in downtown or in that area where that's happening. That impacts all of those businesses as well. That's why these things take a while. So they have to find other ways to be able to generate that money. And you've even heard about, it's almost impossible to, from a construction standpoint, is they're talking about turning office buildings into low-income housing. I mean, that's, again, a massive construction undertaking. So I don't know if anyone's actually done it yet, but they're just trying to find ways to get bodies into town because so much of the money and the success of these businesses around are dependent on that. So we'll see. Like I said, I can't predict the future, but I kind of feel like the genie's out of the bottle with the remote working, hybrid working type thing. I don't see a scenario where people who can work remotely won't be allowed to in some capacity in the near future. The only thing I think might change that is if we had a really bad recession, really high unemployment rates, and people are like, if you want your job, you got to come back 5 days a week, and there was no choice. But that would be, I think, a long ways away at this point. Question here, updates on the recession. When is it coming and how bad will it be? I feel like I covered that pretty well already, which is the giant answer, we don't know. It's not happening this quarter. This quarter is going to be positive that we're just wrapping up now. And we'll just kind of watch how the next couple quarters do. But remember, if we get a recession, we're only going to fall out of the first story, not out of the sixth story like we did last year. Keep that one in mind. It's not the end of the world, again, barring a shock event. What to do with my cash, CDs or money market? It depends. I got this question last time as well. It really, really, really depends on your financial situation and when you need the money. Those are probably the two most important things. On a high level, CDs, when they're FDIC insured, or money market that's FDIC insured, is a different animal. It depends on that one. It's going to depend largely on when you need the money, how much liquidity you need, a lot of other factors. I really feel like this is a question that depends. There are other options available too that can give you potentially higher yield, potentially greater tax advantages in the space of municipals and treasuries. There are also money market mutual funds, which are sort of a kind of a hybrid between that. Nothing I'm saying here should be a recommendation to buy or not to buy any of these, because it depends on your individual situation. So I cannot stress enough to please reach out to me directly. I'm happy to show you some resources how you can look these things up. Or again, if you're not a client and don't wish to talk to me, you can reach out to your advisor or banker. There's some really good resources and tools for kind of looking at these options. But I just want to stress that each of them have their pros and cons, and there's not like a one size fits all. And even if you decide on one, there's some really good places to research the best ones. And I'm happy to share that with you. The good news is that we're pulling about 5% plus in a lot of these cash vehicles right now. So we're back to actually getting paid for cash. It's good. And again, I'm giving you today's dollars at this point in time. Again, not a promissory in any way. Should I invest in target date funds in my 401k? Oh, that really depends. The target date funds, if you're not familiar with them, are basically like a fund, usually a mutual fund, that has a weighting that kind of becomes more conservative as you get closer to the target date on the fund. So they often are the default to a lot of 401k plans and retirement plans at work. They kind of auto enroll you in that based on your age. So, okay, you're going to get the 2030 target or the 2040 or the 2060 based on your age. The concept behind this is that it's more heavily in stocks when you're further from the date, and it slowly allocates itself to being more conservative as you get closer to your date. So there's good pros and cons. The pro to it is actually people are investing money in their 401k because it's the default option. And a lot of people don't do anything about their 401ks, and it just sits there. So at least something's happening to it. The downside to it is as you get closer to your goal, your need for that money in your 401k is going to be highly dependent on your individual situation. So it may not make sense that you're becoming very conservative as you get close to a certain date, because it's really not the date, it's when you need the funds from that. And it also doesn't take into account any other savings that you have. Do you have a pension that's paying you? Do you have investment properties paying you? Do you need this money? There's a lot of personal factors in it. So that by way of saying, it's really, really good to talk to a financial professional, preferably one that's not selling the target date fund, so you can get some unbiased advice, kind of walk that through the pros and cons and decide if it's right for you, because it really does depend on your situation. Will more banks fail? I truly don't know the answer to that one. The conditions that caused the original ones to fail still exist. However, there is a stability, and we're not having the runs on the banks, at least in the current time. So it would probably be some situation that would happen where another bank failed and there was a fear of that domino effect. I don't necessarily think we're out of the woods yet, and I wouldn't be overconfident with that, especially the smaller regional banks. At the same time, it's unknown. It's unknown. There's a lot of factors that could potentially play out also in the bank's behavior. I'm sure it's being watched much more closely now. However, like I said, the conditions that cause this aren't going away anytime soon. They're just subsiding a bit, which makes it less likely than it was when the Fed was being as aggressive as they were, but it's not by any means done. I don't know if this question is based on your holding money, like savings in that bank, or you're holding that bank's stock. If you're holding savings in that bank, based on the Fed's recent action, the Treasury's recent action, FDIC's recent action, you will likely be protected if you're within the FDIC limit, if that did happen to your bank. However, anything above the FDIC limit, even though that has been protected in recent times, it's not a guarantee it will be in the future. So there are solutions for diversifying your money in one account at multiple banks. One account at multiple banks, called a unified account. Talk to me if you want to know more about that, but you don't have to go and open accounts at 10 different banks to be within FDIC limits. I do think a prudent thing right now with your bank money is making sure you are within FDIC limits, whether you do a unified account, do multiple banks, or you're within your current bank. It's a prudent thing to do, definitely. If you hold the bank stock, you're always at risk. Remember, stocks are risk, and everything is at risk by, investing in equities is risk by nature. And as of this most recent, banking crisis time, the government has done nothing to help the shareholders in any way. So bank stock, different risk profile than funds in savings, FDIC insured in the banks. Sorry, I wasn't sure where the question was coming, which side of that, so I want to make sure to cover both. Let's see here. Is the run on the market sustainable? I'm guessing run up, you mean run up on the market is sustainable. So it is sustainable if the number of factors I talked about earlier continue. We have a lot of headwinds, and we also have a tremendous amount of tailwinds. So we kind of imagine a river with a lot of twists and eddies going on right now. It is quite possibly sustainable. However, we will know a lot more the next time we talk when I do the mid-year outlook, because we'll have earnings for second quarter. I would like to sell my home and move out of the area. Is there anything to plan for? Oh yeah, there's lots and lots of things to plan for. One of the most basic is understanding the tax impact of that decision. I cannot stress enough, if you're thinking of doing that, in addition to your real estate professionals that you'll be working with, definitely work with a financial planner. You can talk to us. You can talk to another planner is better here rather than investment, because you want someone that really understands how to do this in context of your overall planning. So preferably a financial planner would be optimal to talk to, and they could just run this one scenario for you. We do this all the time. Other planners, I'm sure, will do it. Just want to understand all the pros and cons to that. It doesn't mean you move or don't move. It means you want to understand, because a lot of people get really, really, really surprised with the taxes. That really shocks a lot of people. They don't really understand the impact of taxes and the impact of taxes across the board, because if you haven't been in a high tax bracket before, sell a house you've owned for a while with a lot of appreciation, and you will experience that. So you want to plan for it in advance. So definitely I suggest talking to a planner. Okay, that was all the nuclear war question. That was another one, so I think I answered that one. And then I think the last one here, are annuities a good investment? And I'm going to save that for next time, because it's sort of a complicated question, and like every other thing I talked about today, it depends. It really, really, really depends. There's really no such thing, as far as I'm concerned, as a good or a bad investment outside of outright fraud, things like that. It really is what's right for you. So it's a really good thing. If someone's talking to you about investing in annuity, it's good to get a second opinion from someone that's not selling the product, or be confident that, this person's not involved in that transaction. The reason being is that there's pros and cons to everything, but it's when you're making a decision on something where you're locking up money for a long period of time, it's really good to be sure it's the right decision for you. So happy to talk to you about that if you want to talk to me, but it's good to get a second opinion for that for sure. So anyway, thank you all for listening. I feel like I covered a whole lot of stuff, and my highest intention again is this was a valuable use of your time this afternoon. And again, this is kind of like the mid-inning update, so there's much to it. Anytime you have questions, please do not hesitate to reach out to me. Send me an email. I will email you back. We will schedule a time to talk. I love answering your questions specifically and personally where it fits in your schedule. And we spend, again, a tremendous amount of time and energy paying attention to these things, watching over the portfolios that I oversee, and advising and guiding clients. I said, I'm like the iceberg. You only see the tip of me. Most of it's behind the scenes doing the work. So this is my exciting opportunity to kind of talk to you in group and then talk to you individually as questions come up. I'm available for anyone that's watching this recording or anyone that you know that wants to get a little more information. Happy to answer questions if I didn't get to those answers to you today. So July will be the mid-year outlook for second half of 23, and August will be ARK investing, the innovation, talking about what's happening next. Any other topics you want to hear about, any other speakers you want, I can bring them in. So just let me know. Thank you all very much. And I look forward to talking to you on the next webinar if I don't see you sooner. Talk to you later and have a great day. Bye.